Chapter 2, The Great Rotation, a river of capital changes course. In Chapter 1, we saw why Bitcoin no longer fits neatly inside the old risk-on or risk-off labels. Now we follow the capital itself. For decades, money moved toward equities when optimism was high, then retreated toward bonds or gold when fear arrived. That rhythm was the heartbeat of global finance. But in mid-2026, that heartbeat changed. The river of capital that had flowed into the S&P 500 began to reverse, while Bitcoin emerged as a new destination for institutional capital. To understand the rotation, we must look past the surface price of the equity market. In the summer of 2026, the S&P 500 appeared calm, trading near record highs with low volatility. But beneath that calm, the internal engine was weakening. The market structure was telling a different story from the headlines. The key diagnostic is the acceleration gap, or A gap. It measures the difference between short-term demand and long-term foundational demand. When short-term demand falls below long-term demand, upside momentum is weakening. When the gap turns sharply negative, the market can be quietly bleeding even before price falls. In mid-2026, the A gap for SPY turned sharply negative and reached its deepest reading in 18 months. That was the first definitive warning sign: fewer buyers, weaker conviction, and a widening gap between a high price and collapsing internal demand. The market was being held up by inertia. The comparative charts show why surface price alone was misleading. The demand ratio and the acceleration gap revealed weakening internal force beneath the equity market's stable appearance. While the SPY engine was sputtering, Bitcoin's engine was beginning to roar back to life. After the capitulation that ended on June 30th, 2026, Bitcoin's short-term demand surged, long-term demand stabilized, and its own acceleration gap flipped from negative to powerfully positive. This was not simply the retail speculation of past cycles. The institutional footprint was visible through BlackRock's IBIT, the spot Bitcoin ETF. The PDF's analysis reports that new Bitcoin ETFs attracted over $1.6 billion in a single week, while equity ETF flows were volatile and inconsistent. The opposing moves were structural. The market clock equity engine showed weakening demand, negative acceleration, and distribution. The market clock Bitcoin engine showed rising demand, positive acceleration, and accumulation. The capital was not merely reacting to a headline, it was reallocating between two different internal force structures. The turning point became visible when SPY's acceleration gap reached its deepest negative reading as Bitcoin's gap reached its strongest positive reading. Institutional capital was no longer experimenting with Bitcoin, it was committing. The Great Rotation is the first pillar of the digital commodity thesis. It shows that Bitcoin can absorb capital during equity weakness, begin to behave like a safe haven during macro stress, and develop an internal force structure capable of standing independently of the stock market. To recap, the river changed direction, SPY's internal structure weakened, Bitcoin's structure strengthened, and the acceleration gap exposed the difference. In Chapter 3, we examine how Bitcoin broke its correlation to the Nasdaq through the sovereignty ratio. This conversation is for educational purposes only and not financial advice. Past performance does not guarantee future results, and investing involves risk. This is an invitation to learn, not a recommendation to invest.